All right. Good morning, all. My name is Harrison Ma. I'm one of the investment managers here at Sharewise, and welcome back to another Sharewise webinar. Today, we're very fortunate to be joined by IDT Australia CEO Paul McDonald. Good morning to you, Paul, and thank you for being with us today.
Thanks, Harry. Good morning, and it's great to be here today.
Absolutely. And this morning, Paul will be presenting, I guess, a bit of an update on the business. This is his second time, I believe, on a Sharewise webinar. So touching base on the context and history, as well as growth opportunities and development going forward as well. So we look forward to Paul's presentation. And just a reminder to our attendees this morning, if you have any questions, we do strongly recommend and encourage participation. So if there's any questions you have for Paul, towards the end of the webinar, we'll have time for that. And as usual, it's recorded. So if you can't make the live viewing in full, it'll be accessible on our YouTube channel. So Paul, I guess over to you, and we'll hear from you to begin.
Thanks, Harry. I'm just going to share my screen
for
the presentation that we recently posted. Now, can you see my screen?
Let's have a look. Yes.
Great.
Yes.
Okay, so this is the half-year results that we just recently published. Okay, so there is a slide here to talk about forward-looking statements. So I would encourage you to read that and understand the obligations of forward-looking statements with us. We're here to talk about the company's results, but also we'll talk a little bit about where we see us moving in the future. So on this slide, we've got some of our key achievements over the last 2 years. So the company really has gone through somewhat of a transformation, a reset, and that process has been taken for around about 2.5 years. We've had some new board members come in, and we've also built up a whole new management team right at the start of that 2.5 years. So some of the key achievements during that time is, well, for one, we're building a sustainable business now that is already 50 years old, that is going to continue back into the profit and a sustainable profit. So we're looking to push through that, and our improved results in FY25 are tracking toward that position. We have a half year that's jumped to 10.5 million, right, from 5.8 in the previous corresponding period. So we're seeing a genuine growth, not just by half, but by quarter, double-digit quarterly growth right through the 2.5 years, all barring one particular quarter. Now, we've also had we're building a platform of products in our advanced therapy line, which is a highly complex manufacturing processes. They're able to sell in the market at higher retail prices. So the contract manufacturer has more room there and a higher barrier to entry to push through higher margin manufacturing. So we see this as our future, right? We're very clear that this is our North Star and where we're focusing on the most, as well as building up our legacy businesses. The sterile filling line extension for clinical trials is a big part of that advanced therapy market growth, right? So we've had a mothballed sterile facility that's been there for many years. We requalified it, we recommissioned that facility, and then we went and got the TGA licenses on that so that we got the freedom to operate and manufacture product, not just for Australia, but for Europe and other regions as well. So we successfully completed that extension. We've put in a new capsule machine, one that can do some 200,000 capsules an hour. We've also put a second capsule machine in as well as part of our radio facility in the bottom point, but I'll touch on that in a moment. We recommissioned 100-litre and 400-litre API plants. They were previously commissioned and operational, but then they were mothballed for quite some time. So we've brought them back out, and they're currently in operation. And I'll talk more about that through the presentation, where I see the opportunities in API. It's quite important to us, beating our bottom line with revenue. The 4,000-litre plant is also It's been mothballed for quite some time, and we're now looking to produce this plant, bring this plant back out of and restore it. And this 4,000 litre plant's effectively the largest small molecule API plant in Australia, right? So it is not operational today, but we expect by the end of the calendar year to potentially have this up and running. So we've begin commissioning stage on that one now. We've built several labs. We've had some storage areas within our laboratories, and we stripped them right back to stick and then replastered, put on the epoxy coatings, the floors. We've put the tables in, and now we're refitting out those labs. We needed to do that for some of the equipment with the advanced therapy processes. When you step up in complexity, you also step up in analytical technology. So we've had to build labs with high-tech advanced equipment in order to measure the products that we're making, that they actually fit for purpose. So there's been a substantial effort over the last 8 months to build, fit out, and commission laboratories for our advanced therapy moves. And then finally, I did briefly mention we have a radio pharma facility. So we're seeing companies like Clarity and Telix really taking off in the radio pharma space. So they have a radioactive metal effectively and radioactive ion, which is put into a medicine which will release and will help in diagnosis of a patient's cancer, or also actually have a therapeutic decaying of the cancer through the radioactivity. So we also have a radio facility that we've built. We've currently got one product running through it at the moment, and they are getting close to commercial approval. That one is a diagnostic radio product. So we're really excited about kicking off that facility and getting it licensed. Okay, so the dot points here, I'll take you as read, but I'm going to just cut because there's more important slides I wanted to talk about today. But literally, we are 50 years old. We've produced many novel chemical entities through our history. Now, what that means is a new molecule that a biotech or a university or a pharmaceutical company has basically discovered that'll have some level of biological activity that has a potential to meet an unmet medical need and try and serve a purpose. They'll come and they'll need to go through an exploratory stage. So we are set up to do early stage phase 1 exploratory work with those companies. We're also set up to expand through the clinical stages and go into a commercial process. We can manufacture their commercial products too. So we are building a pathway to a sustainable profit, right? My goal standing in front of you today is not to get a year of profit and post that. It's about several years of growing profitability, right? So we want to meet that profitability point. We want to bust through that and have several years of increasing profit and produce a company that's going to be around for another 50 years. Competitive advantages we have is really around early stage manufacturing linked to the novel medicines, but also doing things that are very complex, that have a high barrier to entry. If it's difficult to manufacture, it needs a high level of quality and a high level of scientific expertise. It's difficult to replicate, and it's something that, given the R&D conditions in Australia, we're a really good destination for those types of medicines with the R&D tax and IP friendly, and also the phase 1 clinical trial process being one of the fastest in the world. We're well set to take on those very complex, high barrier to entry products and do well. So in that category, you have mRNA vaccines, which is effectively a lipid nanoparticle. It's like a drop of oil, very technically designed drop of oil with the mRNA inside so that the plasma in your body doesn't degrade that product. So mRNA is a complex formulation, and we're well and truly active in that space. Today, we've manufactured more than 5 vaccines, and we'll continue manufacturing those through the year. Antibody drug conjugates is a smart cancer. It's a tumor targeting antibody which is loaded up with poison, with really toxic poison. Now, the difference between an ADC and your traditional chemotherapy is the tolerability of the patient is limited with chemotherapy, whereas a targeted tumor ADC, the tolerability is a lot higher because you're targeting the tumor and not the healthy cells. So this is a very fast-growing technology. It's currently about a $13 billion market, and we expect it to slowly overtake the chemotherapy market. And we've seen analysts project it to be up to 140 billion in the next 10 years. And we're seeing huge licensing deals with Pfizer buying Seagen, et cetera, for $40 billion, and Merck and Daiichi Sankyo doing $20 billion deals. So we know that the ADC market is really hot, and we're entering into that space. We have a strong asset-backed facilities, and we've just completed a $20 million asset-based loan on the facility. So we're quite comfortable with our cash position over the next interim period. The advanced therapies really jumped out and made a big impact into our 10.5 million half year. You can see a huge jump. I've been talking about it right from the start in the 2.5 years of this turnaround, that our advanced therapies is the one that I'm backing to really grow, and it's a really exciting proposition, and the advanced therapy is based on global mega trends, right? Cancer, aging population cancer, vaccinations and respiratory we saw through COVID, but also other opportunities for mRNA to basically serve the function of any deficient protein in the body effectively. And but what we saw during that half, and this is where our opportunity is, right? The API, we found it difficult to cycle our orders through into our plant. So we had facilities ready to go. Most of the staff were relocated into the advanced therapies pillar to bring through some vaccines for Sanofi. But we also had the capacity to do some APIs. So we were unable to get those APIs into the back half of the I guess effectively the second quarter. Those opportunities haven't gone. They've just been delayed. A lot of the clients are US based, and they wanted to push their cash flow into the next financial year, which is a calendar year in the US. So we really struggled to push some of those orders through into that year. The good news is they're all loaded up for the second half. So we're going to see API push through into the second half, and you'll see that pillar grow. I'll talk more about that on the next slide. Now, the specialty orals is more of our neuroscience and central nervous system, CNS type related programs. So again, targeting aging population and neurodegeneration. This is a growing market, and the APIs that we synthesize are mostly in that bucket. So we synthesize the API, we service that pillar, then we take the API and release it and make a tablet or a capsule under our specialty oral pillar. So with the API being a little bit down, specialty oral is going to be down too. So in the next half, as the API comes up, specialty oral comes up too. Now, I did want to talk about our others to set up those laboratories to bring in a key client like Sanofi. We did a lot of management of tasks for buying equipment and materials, and we we spent a lot of time fitting out the technology that they needed in order to produce those batches in December. So there is a margin on those. There is a fee. There's a management fee, but the margins are quite low. So while we got a significant reimbursement or a management fee for those activities, the margins are quite low. So it's kind of distorted our gross margin a little bit as a result. So when we look at our half on half, this is when we started the turnaround. We did 2.4 million in a half back in the first half 23, and you can see now we've been able to grow, more than double digit right the way through to 10.5 in the first half in 25. The light green is the reimbursement and the management fees that I talked about, and you can see the dark green with the advanced therapies really being the standout pillar. And I am disappointed that we could not get the API to the level that we expected, exceeding that 2 million, just shy of 1 million. But the orders are there and they are pushing through in the second half. We have more orders growing in the advanced therapy. So we're expecting this manufacturing revenue to continue to grow through the second half. But I'm proud of this graph. I'm proud of the trend that we're demonstrating and the runs of the board we're putting on. And I expect the trend to continue with the pipeline that we're building. So if I break down here some of the pipeline, some of the orders. So we did generate about $20 million in orders in that first half 25. Some of those orders were converted into revenue during that half, but there's a lot that are lagging and moving into this second half. And of course, we're generating new wins and new orders each month as we move along. So we continue to grow that number in our pipeline. But the pleasing part of this pipeline, you can see that the advanced therapy is really dominating the return contracts. And they're also customers coming back to manufacture more products with us. Now, when you do something the first time, there's a lot of learning. There's a lot of GMP documentation because we're making medicine. It needs to meet the rigorous quality standards to go into people. And there's a lot of work that you need to do to onboard a process, right? There's a lot of work. So we did a lot of that in that last half. We invested heavily in completing those processes to get ready to manufacture those products. So now when we come back for repeat orders, a lot of that's already been done. So it's far more seamless coming back for second time, third time, fourth time. So that puts us in really good shape again for this second half. So really strong orders in the advanced therapy. And then again, you can see the flow coming in late in the second quarter, the second part of the first half. You can see these API orders that unfortunately I wasn't able to nail down to the facility. So they'll come through in the second half and you'll see expansion of API. And then of course you can see there's only a small window here of specialty orals, but a lot of the API gets converted into specialty orals. So we expect to see that orals contract one increase through the next half and then convert into revenue as well. So we've got a little bit of tailwind coming through on those bottom pillars, and we've got a really nice foundation of advanced therapy flowing through the plant. And of course, we're still chasing new clients, and we've got more clients wanting to get into our facility. So again, we've got to manage that process as we onboard them and bring in new streams of revenue. A little bit more color around the return customers and the new customers, right? So new customers are very important to us because it's growth, and we can't grow without bringing in new customers. They do have that qualification period and that transition period at the start, which is quite a challenge for contract manufacturers. We're not alone. And it does take some level of R&D investment to get the process into the facility, understood, and converted into a robust manufacturing process. And the return customers are really it's like golden eggs. These are the ones that come back. We already know to do it. We're familiar with it. We've done it, and we repeat the work. So the efficiencies improve, the revenue increases, and the margins high as well. So The return customers are the ones that are going to push us into the sustainable profitability point, and the new customers are going to keep us growing as we move along. So they're both very important. One's a little more of an investment. One of them is really, pushing our numbers forward. Presented this slide before, but really how we're trying to do this, right? We have a large fixed cost base. We've got 12,000 square meters of facility. We have staff salaries, we have insurance, we have power, we have water. So taking that large fixed cost base, obviously we need to generate an increased generation of revenue and hold the cost base as fixed as we possibly can, hold it constant year on end. And that's why we break through into profitability. So we understand what the level is to meet our fixed cost base. We understand that there is an indirect portion to a pharmaceutical company. You need to maintain your licenses, you need to maintain your facilities, you need to be compliant. And then there's a direct component, people touching the product, manufacturing, testing, releasing, shipping the product, labeling the product. So while we expect that we will still grow our direct portion of the labor, the indirect stay constant, and the fixed cost, as best we can control with our market headwinds, we control those fixed costs. So as we grow, as we continue to bring new clients on, the return work clients become bigger projects. We bust through that fixed cost base, and we're right on that point now. So we go through that, and then we start building a sustainable profit as we continue to sell more and bring in new clients. The mix of the products is also important. We had, at the start of the turnaround, we had a very strong reliance on medicinal cannabis and some of the other psychedelics. They're still there, and that business is still viable. But the ADC and the mRNA and the neuroscience, CNS disorder pipelines are outgrowing those quite quickly. We saw the medicinal cannabis business really commoditize very quickly, and pricing in the market drop rapidly. So we'll sit there and monitor that. And we also notice there's quite a few players dropping out of that market. So while we remain curious and we are still making cannabis products, we believe that might be a business that continues to grow again once the I guess competition becomes more limited. But the focus toward the antibody drug conjugates, the mRNAs, the neuroscience products, these are the products that are going to get us through to that sustainable profit. These are our three pillars, effectively spoken about those in the previous slides. So I won't spend too much time on them, but you can see the breakdown of the revenues through these pillars. And where we want to get to is, we want to grow the advanced therapy. We want the API to be doing, around that 3 to 4 million mark each half. And we want the specialty orals coming out of the advanced therapy up around the 2 or 3 million. So we want those to continue to grow. We do have strong leads in the neuroscience space and the CNS disorder. We've also got many leads coming through for mRNA and antibody drug conjugate. And then we've also got substantial leads coming through in API, which also feed the specialty orals. Sometimes it also feeds the advanced therapy as it gets converted into an injectable. Now we go to the profit and loss statement. To break this down a little bit more, I've spoken about the API stream, and it was difficult to cycle those orders into that second quarter, but we haven't lost those. They're coming through in quarter three. Our operators are synthesizing APIs this week, next week. They're in facility making APIs, so we're going to see the API revenue increase over the next half. The specialty oral is attached to that API. So we know that that's going to contracts flowing into that space. Contracts that are not yet won also flowing into that space. The advanced therapies really was our standout for the last half, and we're really pushing and driving that. You know, we know that there are a lot of contracts to be won here locally in Australia. But we also know that the large population of the advanced therapies are in North America, and probably we're seeing a little bit of attention in East Asia as well. So we know that we have to hit the road and go out there and continue to increase that pipeline, which is steadily growing, more than steadily growing. And then the reimbursements, as I explained, it's a low margin management fees for handling the purchase of equipment, ordering equipment, materials, bringing in materials, storing them, all those sort of administrative type tasks that have a low margin. So I want to make sure that we don't distort the numbers with that reimbursement figure. So the cash generation, look, we were loss making, but we are moving toward that profitability point. Now, the other point I wanted to make here is some of our clients do have substantial payment terms. The larger they are, generally the higher they demand a payment term. So we are putting forward cash to move programs forward, and the receipts are a little bit on a lag. We have spent money on recommissioning facilities to accommodate the growth. We've brought back the 100 litre and the 400 litre facility, which are both busy right now manufacturing APIs. We're bringing out that 4,000 litre plant. It will be the largest in Australia for small molecule. So we're pushing through into that one. We also got the radio lab and the ADC lab up, which was co-invested with the Victorian government. So we've moved through pushing those revenue generating facilities open with really good opportunities. And then you see the capital raising that we did in 24, and then backed by a 20 million asset-based loan to ensure we've got a cash flow running through with our ambitions. So you can see here the receipts coming through, right? As I did explain, there's a lag on those as well, but we're seeing those increase, and we get those past the point of our cost base. There's a lot of work in progress that we've got through that haven't been invoiced yet coming through. And our inventory is set in place, purchased inventory, which will come through as the products manufactured and then go and hit our top line. Share price performance, obviously the result of our work is measured by share price, and we think that we're doing the right things to grow the business, to turn around the business, to put in strategic pillars that are going to grow, and they're attached to unmet medical needs, or they're attached to aging populations and global megatrends. We think we're in the right areas. We can see the growth coming through. So we believe that as we put runs on the board, the share price will continue a positive trend. Probably actually state here as well that the register is taken up by a very large portion of the top 20. So we've got a lot of long-term investors there in the top 20 that support the growth strategy and the process that we're going through. The board, as part of this turnaround strategy, is a very reputable board. They are highly skilled at turning companies around, have many runs on the board for taking a company that's potentially been performing not at its optimal and moving it toward a much higher, more optimal performance. So we've got a very dedicated board that are quite hands-on, that are right into the business to make sure that we achieve our objectives and provide advice and strategy to look at those next levels of growth. A little bit about my background. Come from Pfizer. Most of my background has been in drug development and portfolio management of drug development. I've also worked in the contract manufacturing business. So I've worked on both sides of the fence, being a contract manufacturer and also a contract giver that takes an asset and puts it into a contract manufacturing business. So I understand the business really well. I understand how to grow it. When I was operating the contract manufacturing business at Pfizer, I took it over in year one. It was an $8 million business. And within 4 years, I'd taken it to a $40 million business. So, you know, there are a lot of synergies and a lot of overlays in similarities between that business at Pfizer to the IDT business. So the expectation is that we keep growing, we keep striving forward based on what we've done in the past. So I believe there's a very positive outlook. We have 20 million in contracts won in that last half. Some of them were converted into work during the half, a lot of them coming through into the second half. Plus, we're winning new from that 18 million in proposals. We're winning new contracts every week, increasing the profitability by changing the sales mix, by doing those high value, high barrier to entry products, and just busting through that fixed cost base, which we're right on that point now. Competitive advantages. We have world-class facilities. We also have still quite a lot of capacity to utilize, right? We've got other facilities that we haven't commissioned, and we've got buildings that we can convert into manufacturing. So we have existing free capacity, and we also have other opportunities to produce further capacity in the future. So we've got multiple opportunities for continued growth. Global tailwinds. We are chasing the global megatrends. We're chasing products that are generally increasing in outcome, that they are unmet medical needs, and it's also has some level of attachment to aging populations, right? So we are attaching our strategies to growing markets, to markets that we see as ascending. The product's life cycle and repeat business. I touched on that on one of the earlier slides, right? It really is a key focus to keep bringing in those repeat business. And as a client progresses through phase 1 to phase 2 to phase 3, the volumes get larger, the contracts get bigger, and we start to generate greater margin because we're using the same amount of labor to manufacture greater volumes, right? So we improve our margin as it moves along, and we improve our revenue. So these are really good tailwinds that we have in growing that life cycle. If we were attached to the more generic version of the medicinal market, they're typically depreciating assets, right? You've got more players coming in, fighting market share, driving pricing down. So we're at the front end where we've got appreciating assets as they move through. So it's a really important point. We understand that's expected to grow. And then our financial strength that we've spoken about in the earlier slides, backed by these supporting loans. We talk about a lot of acronyms in here, so I'll just publish that and leave that one as read. And then finally, our statement at the back. But I'll pause there and stop and go into questions, Harry.
Fantastic, Paul. Well, thank you very much. I think that was a very succinct half-an-hour presentation. It gave a really good snapshot of the business, obviously from the strategic transformation, which I believe he said was about 2 years ago.
Yeah, 2.5 years, yeah.
There you go, yeah. And the key milestones of the first half of 2025 already. Seems phenomenal. And the pathway, as you say in your words, the pathway to make sustainable profit.
Yes.
Obviously touching on the financials, the management team, the share price. Whilst we have our attendees prepare a few questions in the Q&A, I've got some of my own as well. What were the key drivers behind the 83% increase in interim revenue for IDT in the first half of 2025? Obviously, you mentioned that advanced therapies was a standout. This is the biggest jump since the strategic transformation, and what do you think was the main sort of driver for that?
Yeah, we did see a large portion of that reimbursement, the management fee type activity. But we also saw, because as I explained, to transfer a process, to develop a process, to get the equipment, the facilities up and running, all those processes, we do take fee for service through all that, and there is a margin. Plus, then the advanced therapy pillar manufacturing. We manufactured several vaccines in that half. That was really the key driver to pushing through those numbers. But the ones that were a little low in the API, we've got a real push to bring those in and increase them in the next half.
Yeah.
So over the full year, you'll see more of a balancing, potentially a balancing of the three pillars.
Okay, fantastic. And just on the margins, you said you are expecting margins to grow ahead of revenue due to operating leverage. When will this become obvious to the market?
Yeah, gross margins on most of the portfolios somewhere around that 40 to 60 mark. Some a little higher, some a little lower. As I explained, there's a labor component to manufacture a product, and if it's a labor component to make like a small amount of product, then it's quite difficult to get strong margin on that. But if a labor portion produces a much larger volume, there's opportunities to track greater margin. So as we continue to win repeat business coming back, we're not investing so much on the trial period and then the implementation period. So we generate a greater efficiency and a greater margin for our per head across the plant. And then, so as those come through and as we see those API facility coming back through and fully utilized, and then pushing out product over to the specialty oral, we're going to see that break well through the cost base.
Okay.
So, we're seeing it in the near term.
Yeah, fantastic. Now, looking at operating revenue, this was something you touched on. Advanced therapies made up 56.4% of operating revenue, which was a massive jump from 6.1% in the previous corresponding period, financial year. Will this vertical become the most dominant part of the business in the future, do you believe?
Yeah, 100%, Harry. So, and that's where we're putting our focus, right? We actually generated in the last half about 14.5 million in sales for the advanced therapy pipeline. Some of that was converted within that half year, right? But there's still more to come in the second half. And we're also very confident in the next short term, we're going to win more contracts and convert more sales into that pillar. So no, we're very confident. We're making really good headroads into that strategic pillar. We have hit all our milestones to date with our clients. So as long as we continue that trend, and we continue to win business, which we've got visibility on, we expect that pillar to continue to grow.
Yeah, fantastic. Now, with regards to API and specialty orals, so I think you said the API does include the specialty orals when you're looking at the verticals and the results, and you expect that to improve, even looking as near term as the second half of FY25.
Yes.
What are their outlooks over the long term?
Yeah, this API has been traditionally a lumpy revenue product for the company, right? The company's 50 years old, and the company sold large quantities of APIs back in the 90s and did really well. The company was really flying with that API business, but there's been a lot of competition come in from China. Recent headwinds for China with the US putting in Biosecure, strategies, and the US wanting to not take reliability of active pharmaceutical ingredient from China. It's creating a little bit of a destabilized market. But that's the advantage for IDT. We're seeing more clients come to us to request API proposals. We're winning more contracts in API, and we're actually scaling up API. Hence why we've got enough proposals and enough wins now to look at opening up that 4,000 litre plant. So the API business is showing all the trends for growth and restoration, right, from potentially where it was back in the 90s. Now, the other part to that API that you mentioned is very closely tied to our specialty oral business. A lot of the APIs we manufacture, we test, release. Now, there's two options for the client at that point. We ship the API potentially overseas, and then they manufacture a finished product overseas, or they leave it at IDT, and then we convert it into a finished product, being a tablet, a capsule, or a sterile injectable. So we're getting more and more opportunities to vertically integrate that API into tablet and capsule. So we've actually won some of that business against our competitors from overseas. So as the API grows, the trend goes into the specialty oral as well. So they both grow together.
Of course. Yeah. Fantastic. If I move now to a few questions, I had a few questions from registrants prior to the webinar commencing. This is the first one. Both operating and free cash flow has been quite negative. What is the plan to turn that around, and expectations to when you'll receive a positive cash flow?
Yeah, we're getting really close, right? We actually had our first positive month in the last half, right? So we've actually got one month that we've achieved that. And as we move along, we are still receiving slightly lumpy cash flows. So we expect we will have some positive months and some negative months. Then we'll have positive quarters, we'll have positive halves, and eventually we'll have positive months, quarters, years, halves, right? So it's a work in progress, and it's very deliberate to generate business and put in technology that's going to be profitable for a long period of time, right? So we are desperately striving to get that break-even point, but we're also trying to build something that has a workforce, a technology, and a facility that will go to sustainable profit, right? So we are getting very close. We're right on that point now, but we've had 1 month of positive. So we want to continue on that plan, have more months positive, halves, quarters, and then eventually sustainable profit margins that the shareholders can rely on.
Of course. And I did like the slide in the presentation on the track record of revenue growth. I thought that was very impressive, and hopefully that trajectory can continue, and that will bring more business and more revenue, obviously. Another question posted prior to the webinar, and something we touched on, Paul, in the backstage of the webinar, was the potential or the outlook on medicinal cannabis and potential it brings. And you did touch on it in the webinar as well. You mentioned how it's a very saturated market. Would this be something IDT could turn their focus back to in the coming long term, or what's your thoughts there?
Yeah, it's a really good question. It's something that I'm very curious about. In our previous year, FY25, we had three largest clients in that year, all doing 1.5 million in revenue. 2 of those were cannabis companies, and one of them was one of the neuroscience companies. Today, we've got 2 clients that are exceeding $5 million in revenue. Right? So last year it was 3 clients, top revenue were 1.5 million. This year, we've already got 2 busting through 5 million. So the maturity of the programs and the processes we've got are increasing in a different direction. That doesn't mean that we're not still curious on the medicinal cannabis. We're not as reliant on it. I felt last year and the year before we're heavily reliant on cannabis sales. So I think the market is got very concentrated last year, and pricing came down, was eroded in the market level. We're seeing players drop out of that market now. So there's a potential for us to go back in and rebuild. We are manufacturing cannabis products every quarter, and we are selling medicinal cannabis products, but we're not as reliant on it to build that revenue to break through the cost base.
Yeah, yeah, that makes sense. Well, Paul, I feel like you've covered so much in the presentation. That's all my questions, and obviously the registrant questions as well. Thank you for being here. I guess I'll finish on a question I like to ask most webinars I conduct is, where do you see the business in the next 2 to 3 years? Obviously, we touched on the short term, but what excites you about the long-term prospect and potential for IDT Australia?
Yeah, like that half on half chart that we showed. We also got a quarter version that shows basically the same trend. I'm excited what our future holds, right? We've invested in the technology, the people. We have grown our employment base, but it's particularly around critically needed hires or increasing the number of direct manufacturing hires so we can manufacture more. We can have more facilities running at the same time. We're going to bring out more facilities from mothballing, and we're going to condition them and increase our capacity. We're going to increase our capacity utilization. I'm really excited that we expect to continue the trend on half that we've got. We'll bust through the cost base in the near term, and then we'll set up the company for a sustainable profitability long term, right? So I'm excited to see where we can get to. What we've done in 2.5 years is I would have liked to have got a little bit further, but I'm proud of what we've achieved in 2.5 years. But if we continue on that trajectory, we'll be really proud of where we are in 5 years.
Yeah, absolutely. I completely agree. I think the potential is astronomical, as you've obviously outlined very clearly. And I guess from my point of view, I'm excited to see what the share price does and how it performs, and obviously just the overall success of the business. So, Paul, thank you so much for joining us this morning on behalf of myself and ShareWise. And I do hope we can have another webinar in the future, maybe towards the end of the year, to see how it all panned out, and to talk about the next level of growth that the business is, I guess, got in the pipeline.
Thank you, Harry. Thanks for having me today. Thank you to all the shareholders for paying attention to the presentation and the questions today, and for proposing your questions also during the process. Much appreciated. Thank you.
Absolutely. Thank you, Paul.
Take care.